Hello, everyone, and welcome to another episode of the KDI Wealth Alchemist. Shane and I are here today to give a mid-year update, talk about what's happened in the first half of the year and what we're looking at going into the second. It's hard to believe we're already halfway through. Feels like it's flown right by, and it's really been an interesting one. No shortage of things to follow this year. Some of that is AI related spending, upwards of $700–800 billion by a few of the big names, and the effect that's had on markets. We saw the largest IPO in history ever, and that was by a significantly wide margin. Precious metals, gold, silver, platinum have all hit all-time highs this year. We've got a conflict in the Middle East that is hopefully winding down, but we're still waiting on a final resolution. We have a new Fed chair, Kevin Warsh, that got appointed. And despite all that, we've hit all-time highs in pretty much every major indice so far this year at some point. So, Shane, wanted to pop it off to you for an investment themes. What's been driving the market?
Thanks, Dylan. There's definitely not a shortage of what to talk about today. From an economics and markets perspective, the driving factor is some strong fundamentals. So first quarter 2026, earnings per share up 26.9% year over year, which is a significant jump from early expectations, which were around 12%. And importantly, about 50% plus of that growth has been driven by tech, AI, highlighting just how concentrated some of the strength has been. From an economic standpoint, the U.S. economy has grown over 2.1% seasonally adjusted annual rate in Q1. We've seen some moderation in consumer spending, but that's been offset by increased business spending and business investment. Consumer spending is being bolstered by spending of the upper income households. So there is a disparity there, which we'll get to a little bit later in the conversation. But we've seen some huge gains in wealth over the past 4 years in some of those upper echelon income households. On the labor side, the May jobs report showed 172,000 jobs added, which is well above any expectations that were put out there. What's encouraging in the job growth has been fairly broad-based with strength across public works, leisure, and healthcare. So lots of strong fundamentals. Overall, though, while there are pockets of slowing in the economy, so there are some yellow cautionary signs, the markets remain more resilient than expected coming into this year. With that being said, Dylan, when you talk about some all-time highs, you talked about precious metals. When we look at the broad-based indices, where are we so far year to date?
So as of today, it's right at the end of June here. The S&P 500 and the Dow Jones are up 7.2% year to date. And the NASDAQ, the tech-heavy indice, is up almost 9% at 8.9% so far this year. Bonds, depending on which indice you look at, are flat to slightly negative. And one of the things that we've seen is an outflow from the Mag 7 stocks into the rest of the market, which we've enjoyed, and open up the market breadth as to what people are investing in today. And even though the performance looks strong across all these indices, it's been driven by a small group of companies.
Thanks,
So,
Dylan. I would say that, especially in the AI space, you start to see some names not as talked about much in the last couple of years. Micron Technology has had a huge run this year, AMD as well. Not that NVIDIA hasn't, but again, a few of these other players are coming into that space and making a name for themselves as well. Switching gears here, Dylan, as we look to some of the other big news for 2026, the Fed, inflation, and interest rates. Can you give us a little bit of a rundown of the new Fed chair, along with expectations for inflation and maybe what expectations for rates as we move forward through 2026?
So we're a bit out from the first FOMC meeting this year, where the new Fed chairman, Kevin Warsh, was appointed, gave his first talk to the public. We saw a shift in tone from the prior Fed chair. He wants to be a little more streamlined in his communication style, give a lot less explicit forward guidance. He didn't show a dot plot, which has been very popular in years past, and express continued commitment to a 2% inflation target. We're not close to that today, but that is the target that we want to get to. And in this June meeting, they held rates steady in the 3.5 to 3.75% range. Today, it appears that the Fed is comfortable just remaining patient and seeing where things shake out the rest of this year. Inflation is running above target about 2%. above where we want to be. So right now we're seeing that rates will stay higher than we'd want them to be for longer, unless we see some meaningful progress on inflation. A large portion of this is the conflict in the Middle East, with oil prices being elevated throughout the first few months of this year. Today, oil's around $70 a barrel, down from 100, 110 at certain points throughout this year, which really has been a strong provider to some of that inflation that we've seen so far this year. So if we see a durable resolution to the Strait of Hormuz and keeping that open and what that might look like, we're hoping that some of those inflation numbers drop throughout the rest of this year.
I think a big underlying conversation that's happening right now and the decision point for where the Fed moves next is when we look at inflation today, as every American's feeling it at the pump with what's going on in the Middle East, and because of how much oil has an impact on the CPI calculation, it's determining, A, is this a temporary inflation bump due to the conflict in the Middle East? And I think as we start to see how the Middle East unfolds and tensions be eased over there, the Fed can get more clarity on, is this a true inflationary movement or is this something that was just temporary and a bump in the road? So more to come there. I think that was great, Dylan. And I wouldn't want to be in Kevin Warsh's seat right now.
No, he got thrown right into the fire there, and we'll see how he navigates it. With gas prices and consumers feeling it at the pump, do you want to go into some of the spending behind consumers and the economic backdrop, big picture?
Yeah, I think when we look at consumers and the economy, probably some of the bigger pieces here is what I mentioned a little bit earlier, that some slowing in consumer spending, right? But it was bolstered by business investments. When you look at it economically, you haven't seen that little drop. When we talk about the slowing in spending, it depends on your income threshold and the households. Our lower income households are spending less. Higher income households are carrying a lot of that consumer spending. One of the charts we were actually just looking at before we hopped on here was the fact that some of our lower income thresholds are spending more than what they're making. Actually, 60% are spending more than what they're making, which means that they're ultimately actively consuming debt. So that's one headline. Other unemployment rate sits right around 4.3%. As we all know, the Fed has two jobs, control unemployment and control inflation, right? And it's a tug and pull game that they're always working on when it comes to those two factors. The housing market, also a big storyline for the year. It remains constrained by higher rates or rates that we haven't seen in quite some time. The average 30-year mortgage is sitting right around 6.5%, 6.49. So give you some context there. The average age of a first-time home buyer today, right now, is 36 years old. Forecasting 0 to 2% housing prices increase throughout 2026. So historically speaking, housing prices have grown around 3%. We're expecting anywhere from 0 to 2, so a bit below average for 2026. Of course, an increased sensitivity to borrowing costs due to where we see interest rates sitting. So some of the yellow indicators within the overall economic outlook, but we wanted to make sure we touched on it today just because those are a couple of things that either you or your families or grandkids are all facing right now when it comes to what we're experiencing at the pumps, as well as what we're experiencing when we're going to either buy houses, sell, or get into a new one. With that being said, I want to shift gears back to the rate environment and valuations. When I say valuations, we're looking at valuations of different equities, of where the market sits today. When we talk in client meetings, a froth in the market, where we might see a little bit of a premium right now. Dylan, give us a little rundown of what you're seeing currently when we look at the equity markets.
So the S&P right now is sitting at a price to earnings ratio on average of about 20 times earnings, which long-term average, a little bit lower than that, right around 17, 18%. So there is a premium in the market. We've seen that drop from the beginning of the year where it was closer to 22 times earnings. One piece that we're watching closely is with some of those recent run-ups, like you said, Micron, AMD, some of those tech names that have just performed amazingly this year. In the technology sector as a whole, that price to earnings ratio is sitting at about 36 times earnings. So significantly more valued. People are expecting more from the tech sector. And a lot of that is AI and the profitability that people think that will bring. And when we look at rates and the rate environment we're in, with the Fed keeping rates steady, likely until the end of this year. And with those increased rates and borrowing costs that they can pull from, equities and the risk premium that investors take on by investing in companies rather than fixed income when they can get a greater yield today has to increase. So people aren't going to take on risk if they're not getting paid for it, essentially. So it essentially lowers valuation multiples over time in equities when rates are high. So we have strong earnings growth, but higher rates also create a headwind for some of those valuations. As always, we speak through just about every client meeting, wanting to diversify, and whether that's into different companies, sectors, countries, there's many ways to do it. And shifting, when we look at the bond market, we see that most bonds today are priced for the inflation and potential Fed rate hikes. They like to factor those in. And so we've seen the short end of the yield curve bump up significantly the last month or two and gives you a significant pickup versus just sitting in true cash. So with that, we come back to concentration risk and spreading out over the market.
Getting back to the basics of making sure that, and again, this is what's most important when you look at the market, is staying diversified, staying well within the risk tolerance of your time horizon. I think if you keep those factors in mind and don't get mesmerized by what equities are doing now or how much growth we're seeing in the AI tech sector, you can have some exposure, but it's making sure that we maintain our principles and staying diverse. I'm going to add a little bit of color commentary there because I think it's been a conversation that's come up a lot in client meetings and coming up even from different analysts is comparing the exact experience we're in right now to what we saw in the late 90s with the golden era right before when internet exploded. And we're seeing the same right now with AI. I think a big difference here when we look at these different internet companies that were driving growth, just like we're seeing with these AI companies, a lot of those companies in the late 90s didn't have significant strong earnings behind them as we're seeing today. There was a huge run up in the markets, but earnings shot through the roof. And I think we have today more earning proof behind some of these AI companies that we weren't seeing in the late 90s. Now, with that being said, nobody has a crystal ball of when maybe this AI run will run out. As we saw in the 90s, it was a golden era of growth. And then we had what was called the tech wreck or the dot-com bubble right at the end of the 90s, early 2000s, where the market went into recession. So always something to consider. And that's why, again, sticking to your principles, staying diversified, and making sure that you're invested for your time horizon and your risk tolerance is by far the number one key factor of the success for long-term investing. What, Dylan, would you say as we head into Q3 and Q4 of 2026, what we're watching are our focal points at KDI?
There's 5 or 6 key things that we're looking at today. And we look at many more than that, but the ones that we think can make a significant impact for the rest of the year is the direction of inflation and whether that continues to stay elevated or whether that falls back down. We're watching that closely. And related to that, what the Fed trajectory is going to do and whether they hold, cut, or hike rates. We're deciphering what we can from those Fed meetings. Corporate earnings and seeing if growth continues and making sure that there are earnings behind AI build out, like Shane was saying, and whether that's sustainable. We're, of course, going to be monitoring everything that's going on in the Middle East. That changes day to day, hour to hour at this point. We're also looking at the labor markets and employment markets as well, seeing any possible cracks there. Those are the big things that we're looking at today, that if any significant change happens, would likely cause a significant change in the market.
I think you're spot on there, Dylan. I would say it comes back down to, on average, we know if we're looking at just domestic markets, the S&P has experienced about a 14% drawdown at any point in time during a typical year. Yet, with that being said, we saw a nice little drawdown early in March of this year. Even that being said, it historically has averaged around a 10% annualized return. So volatility is normal with everything going on, geopolitical conflicts. We expect volatility as we move forward. Again, it's why being diversified, investing internationally, investing domestically, investing in fixed income and equities, using your time horizon as well as your risk tolerance to build out your portfolio, not get drawn in so much to the noise is what's most important and ultimately what's going to draw success long term for you as an investor.
Very well said. Like to invest to your plan, and not everyone has the same time horizon or risk tolerant. It's very personalized. And of course, if there's any questions, reach out and give us a call. But thanks for tuning in to the mid-year update and another episode of the KDI Wealth Alchemist. Have a great day, everyone.